Living off of cash and then your Social Security can put you in a pre-RMD tax haven early in retirement. The problem is it doesn't last. Should you enjoy these few years of no taxes, or should you strategize instead? I've got the scenarios, that and more coming up. There are a couple opposing forces many people face early in retirement. These are considered the retirement gap years. This is between when you retire and when required minimum distribution starts. And those opposing forces are RMDs, or required minimum distributions, and Social Security, the tax you pay on your Social Security. If you're familiar with this and you're a fan of the Wise Money Show, you know we talk about this a lot. It is one of the most confusing things. Social Security, is it taxable? Some people will say yes, some people will say no, and it absolutely depends on your situation. Well, it depends on what specifically. A calculation is done each and every year to look at all of your non-Social Security income. So your interest income, your capital gains, your pensions, your IRA withdrawals, and other income, all of that plus half of your Social Security. If you're a single individual, single filer, then that formula, that math, if that number results in a number bigger than 25,000, then some of your Social Security starts becoming taxable. Just a little bit, $1 for every two that you're over that limit. And so the higher and higher that income, that number goes of that formula, more and more of your Social Security gets included on your tax return, and up to a maximum of 85 cents of every dollar of your Social Security lands on your tax return. For married filing jointly, that same formula is done, but if the result exceeds $32,000, then some of your Social Security starts becoming taxable. Those numbers, those thresholds, they've never changed. That calculation has never changed. It started with just one tier, and then in the 90s they added another tier, but it's never changed. Those numbers do not increase with inflation. And what that means, yes, there is inflation. Even there's cost of living adjustments with Social Security. Guys, this means that more and more people have to pay tax on their Social Security each and every year. You need to plan ahead. If you're hoping to leverage that formula, pay less tax on your Social Security, you can do so, and do so intentionally with your tax planning and how you're saving up and building wealth. But that's how tax on Social Security works. Required minimum distribution, how does that work? Well, it used to be at age 70 and a half, you were forced to do a calculation and to withdraw some money out of your IRA. They've moved that age to age 72, and now it's 73, and it's set to change to age 75. But this is the IRS, their version of saying you've delayed and deferred taxes on that pre-tax money, your traditional IRA, your 401k, for too long. We're going to force you to start withdrawing some dollars so that we can include it on your tax return and have you tax it. And guess what happens? If you're not already withdrawing a lot of money out of your IRA and now you're forced to draw out even more, well, what does that do to that formula for taxation on Social Security? Yeah, it can move some people. It can move some people from, I'm not paying any tax on my Social Security, and therefore I'm not paying any tax at all because these deductions are so big, standard deduction, now senior deduction, and it can force them to, oh my goodness, now I have to pay the maximum amount of tax on my Social Security. 85 cents of every dollar of Social Security is now being taxed. That's far surpassing my deductions. And I went from the 0% tax bracket into the 22% tax bracket. So here's a scenario. A friend of mine reached out to me just recently. We are not doing comprehensive financial planning. We're not even preparing their taxes, and it's a friendship, and so there's not full planning, and so that's where there's some gaps. But here's the situation: 67 years old and retired for a couple of years, and she's got extra cash saved up, so she's just been living on that and living on Social Security. It's been very easy, right? She's managed her cash flow and managed her lifestyle, and it all fits. And she just takes withdrawals out of her IRA when she needs it, about 12 to 15 grand a year. Not much. Well, she just did her taxes this year, and again, barely had any of her Social Security land on her tax return, such a small amount, but that when you add that plus the 15 grand that she was, that she had I think maybe last year was 14 grand that she had taken out of her IRA, she was paying no tax, no tax again, no federal taxes. And so she raised the question, should I be drawing more out of my IRA? You got to be careful. This is that double-edged sword. Right now, she is in that pre-RMD, pre-required minimum distribution tax haven, and she is paying no taxes. She's in the 0% tax bracket. But if you understand that formula, for is Social Security taxable, if you're not planning ahead, if you're not doing the math, you could start drawing some more out of your IRA, and all of a sudden, instead of, withdrawing 20 grand out of your IRA and having to withhold taxes or pay taxes on that 20 grand, you're pulling 20 grand out of your IRA and having to pay taxes on another 10 grand or 15 grand from Social Security that you didn't expect. You've got to plan ahead. That's the double-edged sword. So here's the question. Should you, if you find yourself in this situation, should you just enjoy these no tax years, this gap, or should you strategize? Should you optimize it? Well, I say you've got three choices, okay? And it depends on your entire financial picture, what your future required minimum distributions are, your health, your estate goals, and it depends on all 6 areas of your financial life. That's why you've got to do this intentional work with your CFP. But let's say there's 3 strategies, and one is to enjoy these few years of paying no tax. However, that's my least likely. I would rank that one third. At the top of the list, for many people in her situation, she's in the 0% tax bracket. Maybe some years might be a little bit in the 10%, but 10% tax bracket is low. Right after that, the 12% tax bracket, that is low. I would, and this is option number 1, suggestion number 1, optimize filling up the top of the 12% tax bracket. What would it look like above and beyond what you're drawing out for your lifestyle to do a Roth conversion of another 15 grand or 20 grand or whatever it is, just throwing numbers out there, didn't do that math, but whatever it is to fill up the 10% tax bracket and fill up the 12% tax bracket. Yes, that would mean a lot of your Social Security would land on your tax return. However, you would be paying the least amount, you'd be paying the most tax at the lowest possible brackets. And if you did the math and that kept you from being into the 22% tax bracket out there in the future, then the math works. And that would be a strategy that, assuming a long life and life expectancy, that would be a strategy to mathematically reduce the amount of taxes that you pay over your lifetime, even though you'd be paying more taxes during these gap years before you start your required minimum distributions. So that's option number 1, is I would look and I would do the math and optimize, well, how can we do Roth conversions to pull dollars out up to the top of the 12% tax bracket and nothing more. Now, if that math revealed, okay, well, that helps, right? That helps, but once RMD starts, we're still going to be in the 22% tax bracket, then I would consider this next option. And for some people, this maybe is the one that you should consider. And that is, for a couple of years, do a much bigger Roth conversion and actually be willing to get into the 22% tax bracket a year or two, because your Roth conversions are so big. You want to stay below that IRMA threshold, income related monthly adjustment amount threshold, so you're not having to pay a surcharge on your Medicare, but doing an even bigger Roth conversion for a year or two into the 22% tax bracket, if that meant more of your IRA was transitioned to your Roth, and therefore the projected required minimum distribution then out there in the future on that smaller IRA is going to keep you in the 12% tax bracket forever. Because that's the math. It's not just, well, 22% here, 22% there. No. Once your required minimum distribution starts, it's likely that you're going to be in that same tax situation for the rest of your life. Because the required minimum distribution is a calculation that's done off of the balance of your IRA. And yeah, you're withdrawing dollars because it's required. You've got to take some dollars out. However, that required minimum distribution, that calculation means you got to take out a little bit more. It's a little bit bigger amount each and every year. If your IRA is declining rapidly in value, then that could change things. However, most people, it's a little bit more that they've got to take out each and every year. And therefore, once RMD starts, if you're in the 22% tax bracket, assuming tax rates and brackets stay the same, you're going to be in the 22% tax bracket likely for the foreseeable future. Therefore, it may make sense to do the math. This would be option 2, to say, well, what level of Roth conversion, bigger Roth conversions could I do in 1 year or 2 years? Yeah, paying the 22% tax bracket for those years, but then be able to stay in the 12% tax bracket from there on out. That's just speculation. You got to do the math. Don't guess, do the math. And then when you do the math, look at to see how does that fit within your financial priorities, the rest of the areas of your financial life. We're really talking about tax planning. That's the third area. But yeah, this impacts your retirement planning, the fifth area, your investment planning, absolutely the fourth area, your estate planning, the sixth area, your cash flow, present financial position, the first area. The second area is protection planning. So Medicare, that's where you want to stay below that income-related monthly adjustment amount level. But it touches clearly 5 out of the 6 areas of your financial life. But that's what I would do. I would order it that way. If you're finding yourself in this pre-RMD tax haven, should you just enjoy these no tax years and then kind of just pay the piper for the rest of your life once RMD starts? That's an option. I'd put that at the bottom of the list. First, I'd optimize and fill up the 12% tax bracket. Second, I would consider whether it makes sense to have a couple of very large income years so that you avoid the 22% tax bracket each year after that. You got to work with your CFP on that, looking at all 6 areas of your financial life. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.